Real estate versus Bitcoin, and who wins? I'm Dave, a multimillionaire Marine Corps veteran who's invested in both, and I'm going to explain the pros and cons of each, as well as, the kind of the more balanced style of investing that'll actually help you achieve that financial freedom in a much more guaranteeable way. And I know I hate to use the word guarantee when we talk finances, but I mean, it's a much more consistently guaranteed outcome as far as being something you can replicate and you can anticipate and is not that might just totally. Okay, the very first thing here is what's called the Lindy principle, which just basically states that an object that's been around for a certain amount of time will stay around for around that much time. And I know this is an odd sounding principle, but basically what this means is if something is brand new, the likelihood of it staying around for a very long time is very hard to guesstimate. And if something has been around for the test of time, the likelihood of it staying around is a lot easier to estimate. So perfect example, right? Let's say we'll use the Jeep Nitro. They just announced this, or Dodge Nitro, whatever it is, that is, they just announced this car. It's a very new model of car. Because it's in its first or second year as a possible buy, we have no idea if this is going to last for the next 50 years with different models of the car. It's brand new. No one knows. It may be there for 1 year, 2 years, 3 years. It may never come back. But if you look at like the Jeep Wrangler that's been around for 50, 60 years, pretty good assumption to think they're going to keep making it because it's a popular car. It's time tested. It's been around for a while. Corvette's the same way, right? The longer something's been around, the easier it is to say confidently, hey, that's probably going to stay here. Right? And I know I'm just talking cars, but I like cars. But there's a lot of other examples for this, right? You could use the example of vape. Vape came and it kind of went very quickly. I mean, it's still around, but it's not like the craze it was. Cigars, on the other hand, have been around for centuries and they're still here. They're still going to stay around. So this is just an easy way to say, hey, if we're extrapolating, right? The real estate market has existed for the existence of humankind. Now, it might not be the exact same way that it was 1,000 years ago, but real estate was a thing. This goes back thousands of years where you're talking about plots and, all the different ways that real estate has grown over the years, but crypto's been around for 10 to 15 years. Now, I mean, there's some stuff in theory that's been around for maybe 20, but I mean, it's a fairly new market. So we really don't know what it's going to look like. A perfect example of this, the internet. The internet, obviously, at this point, everyone thinks pretty certain that the internet's going to stay around. But in 1999, when the internet there was the dot-com bubble where everything crashed, there were a lot of people who were like, well, the internet was a fad, it's done. Right? Because we didn't know, and it had just been around for a minimal amount of time, so it was new. And you're like, well, Dave, okay, great. This doesn't make any sense to me, and it doesn't matter with me for investing. But here's the thing. Markets are very driven by emotion. And I know we don't, people like to say they're not. But the more that people are betting on, buying into, and investing in a thing, the higher the demand, the more it's going to improve. Right? That's just normal supply and demand logic. Conversely, if everybody's running like the sky is falling, that investment's not going to do very well. A perfect example of this is the old tulip mania, which is essentially this time period back in medieval times where tulips were valued for trade. And the more valuable they got in trade, the more mania there got around it. The more people were just willing to trade and do anything to get these special kinds of tulip bulbs. And at one point at the height of this, people were legitimately able to trade a house or two or, housing land property for tulips. And then when the mania went away, when the, emotion went away and people realized this is flower, it crashed, it tanked. It was the biggest and most notable boom and bust in modern history. Go look it up. Tulip mania. It's wild. And this is exactly what happens when people drive, or GameStop. GameStop's a recent example. Drove it up through the roof and then it crashed hardcore. Doge and a lot of these things are very similar. Crypto is a very emotional, volatile market right now. Now, I'm not talking about the technology because I really like the technology and the use case, and I do invest in cryptocurrency. But it is volatile. It's a new market. It's volatile. We don't know what it's going to look like, whereas real estate is very tried and true. There are cyclical aspects. It does go up and down. It does not always go up. But over the long term, it's pretty easy to say the last 100 years, real estate's performed an average of 4%, 5%, whatever that number is. Whereas with crypto, you're like, well, the last 15 years, it's performed an exorbitantly high return that we cannot anticipate likely to continue, but we have no idea what the normal, averaged out stability is. So we're kind of speculating on whether or not we're going to, keep going or just crash, right? There's It's short, Lindy. It's just, there's not a lot of data there. Volatility plays a large role in investing. And so while I like crypto, and I think you very well can put some money into it, and I mean, I think it's actually more of a gambling right now than an investing in a lot of ways, but you can do very well, and a lot of people do very well. What I would say is this: crypto should be an insignificant portion of your portfolio, like 5 to 10% of your portfolio. And the reason for this is what we call the barbell theory, which is essentially like you have some stable investments and then you have a few that are very volatile. And what happens with this is if 90% of your wealth is in something that, let's just say, breaks even, then you're good. You're not going to lose it. And if the other 10% is in something incredibly volatile, what you do is when it takes off, you sell some of it and balance it out a little bit against your portfolio to keep that weighted to 5 or 10%, because as it skyrockets, it'll go to 20% of your portfolio, 80% of your portfolio, and you want to balance it back to 90 by selling some off to buy some of this stuff. So then when it takes off, you're hedging by putting those profits into more solidified assets. And then if it plummets and it just goes and implodes, then hey, you're like, wow, it's kind of bottomed out. I can throw a little bit more in there, but you're buying at a very low level. But also if it tanks, it was only 10% of your net worth. If you throw all your money into crypto and it tanks, you're on the streets, right? So this is a downside. A lot of guys in the last 4 to 8 years when crypto really booms that I'm close to, I've kind of talked to and been like, hey, while you've got hundreds of thousands, if not millions of dollars in Bitcoin, you should siphon off at least enough to buy 1, 2, 3, cash flowing, maybe even debt-free or just 50% debt, really solid cash flowing, quality real estate assets. Because then if your crypto portfolio nose bombs or dive bombs or whatever, tanks, you have a base of a cash flowing asset that you can take that money and put back into crypto from your profit. But if you leave all your money in crypto, hoping it continues and it doesn't, you're screwed. That's not a pretty spot to be in if it tanks. And now you're like, there are people who legitimately have unalived themselves over results of this very volatile market because it is an emotional swing. And so you don't want to be in that spot. So you want to balance this by placing what we call asymmetric bets, which is something that could go, instead of being like, hey, it's probably going to earn 7%, it's like it could go 1,000x up or 1,000x down as a very small percentage of your portfolio, 5 to 10%, and then putting something more stable as the other 90 to 95% to balance out that risk. And then you adjust accordingly to keep those similar levels. There are a couple other things here that really make me like the real estate market. One, banks will lend on it, right? Banks are very risk averse. And so banks are bullish on real estate. They invest in real estate. It's a stable asset class. They underwrite it for you so you make less mistakes. They believe in it and they're willing to bank money, meaning you could take 10 grand or 20 grand and buy a $100,000 property, depending on what kind of loan. You could actually take zero money and buy a $100,000 property if you use the VA loan, or $3,500 and use the FHA loan. But, if you want to learn how to house hack and do that, go check out my VA loan videos. For the sake of this video, let's say you take $25,000, 25%, throw it into a $100,000 property. Or if you're like, well, $100,000 properties don't exist, great, then add a zero, $250 into a $1 million property. I'm trying to do easy math here. So you take $25,000, you throw it into a $100K property, and then the bank will lend on it. And now if that property goes up 5%, you get 5% of the total value. So you put a quarter of the property's value down in cash, and you get the 5% return on the total $100,000. That's what we call leverage. It's very powerful. But if that goes down in value, you really only have the equity in it that you can lose. Now, obviously if you go bankrupt or whatever, but this is why you buy properties that cash flow and they cover their own expenses. I have a ton of real estate and it covers its own expenses. And if the market dips, I just keep holding on to it to continue covering its own expenses. And over time, it'll buff, right? It'll bail itself out. Market will swing back up. I'll be good, rents will go up, life will be good. That's what happens. It's cyclical. You just have to be able to hold on to real estate long term. Whereas with Bitcoin, a bank isn't lending on it. There's a reason for that. It's very volatile. But because they're not lending on it, you would have to have $100,000 in Bitcoin to have $100,000 worth of Bitcoin. If it goes up 5%, you earn 5% on your 100 grand instead of essentially 20x on your 25,000. And if it goes down, that is your money, your real money that you're losing, not the bank's money, and you can just kind of keep floating it to come back up, right? So it's a little bit more risky again in that regard. Another huge one here is tax advantages. There are no real tax advantages to crypto. Now, people say you don't have to pay taxes on crypto. I don't think that's true anymore. And even if there are still some loopholes, it's going to go away. There are going to be capital gains tax on crypto. There's going to be capital gains tax on any investment you play into. However, with real estate, between depreciation, which is a fancy word for writing off the value of the fixed assets on your land, or cost segregation, which is a fancy word for accelerating how fast you can write that off. And then there's also the 1031 exchange, which means you could sell a house, profit, and instead of paying the taxes, you just roll it into another property. There are stipulations there, but it can be done. And you could honestly continue doing that all the way until you pass away, probate, which means that your heirs would then inherit that real estate without paying taxes on it. They would inherit, it's called inheriting at a cost basis, which means whatever it's currently worth, that's what you inherited at. So if it goes up from $100,000 to $1 million and you sold it, you pay $900,000 worth of capital gains tax. But your heirs, if you just died and passed it away in probate through your estate planning, would inherit it at $1 million value. And then if they sold it at $1 million, they'd pay zero in taxes, which is really, really cool. So look, here's the bottom line. Both asset classes matter. They're both valuable. I do think that the crypto tech is going to stay around for a long time. I don't necessarily know if any of the current coins or which ones will last long term. We don't. There is a chance, and I'm not saying this is what's going to happen, there's a chance that crypto will go the exact same way as the dot-com bubble, and at some point it'll just implode, and 95% of the existing coins will never be heard from again, and the other 5% will stay around, and a whole bunch of new ones come around. That's what happened to .com, right? All these people were speculating on websites and starting all this stuff, and the vast majority of them got wiped out. You never heard from them again. And then they came back around, and when they came back around over long term, they have new domains, new websites, and it's been obviously we've seen the internet, it's a very valuable resource. There's a chance that happens in crypto. And there's all these people online who will tell you that it'll never happen, there are all these reasons, but they don't know because, again, crypto's still new. We don't have true, validated, long-term data to support what will happen with this. The whole Lindy effect makes it hard to justify spending a significant amount of your income or net worth investing in something when you don't really know. That's not investing. That's called speculative investing or speculation or gambling if you want the bare bottom, boring terminology for it. The bottom line is this. You should have all of it in your portfolio. And we didn't even talk about stocks and index funds here. There's a place for that, and I love those. I do invest in those and IRAs and Roths and all the different things. But for the context of this video, if I'm you, I'm investing a significantly larger chunk of my money into real estate and long-term fixed debt assets or cash purchased, low leverage, whatever, real estate, depending on what market cycle, but long-term fixed assets, proven track record properties. And I'm investing a smaller portion into crypto. And then I'm balancing it out as I go to try to maintain that 5 to 10% of my portfolio over here. When it skyrockets, I pull it over here so that if it comes back down or when it comes back down, I've still got it over here and I can buy again and you can play this game. And that is the more secure and I don't want to say intelligent because I don't want to sound like I know everything, but that is the safer way to bet. And you want to hedge your risks in any investment strategy that you're getting into because you can't afford the loss of ruin, which means you can't afford to get wiped out. You can take every little hit or, maybe you just don't get quite the same return as you could have. And that's the hard part with this is when it skyrockets is saying, oh, well, imagine how much money I could have had if I had all my money in there. Yeah, but if it went the other way, you'd be toast. You'd be unalived, whatever. You do not want to risk that ruin. Financial ruin is terrible. I've seen people go through it. You don't want to go through it. So hedge your bets and ensure that no matter what, your longevity is always at the focus of your investment portfolio. So if you're asking me, real estate trumps Bitcoin. These are a couple of the reasons why. That said, comment down below whether you're in team real estate, team Bitcoin, and why, and let's have the debate in the comments because I'm curious if the hypey new shiny thing is going to outweigh the long-term boring thing, or if you guys think like me. Love you. Have a great day.